The Federal Reserve Bank will either cause the stock market to boom or crash come December 14th when they announce their next interest rate hike. If the Fed decides to raise interest rates by 0.5% or less, you're going to see a short-term boom in the stock market. But if the Fed decides to raise interest rates by 0.75% or more, you're going to see a downward shock. What investors are trying to figure out is how aggressive the Federal Reserve Bank is going to be from here on out when it comes to fighting inflation. If they believe that the Federal Reserve Bank is going to be more aggressive than what they think, meaning that the Federal Reserve Bank is going to continue raising interest rates more aggressively, that's what I'm talking about, the 0.75% interest rate hikes and more. If that happens, then traders and investors are going to say, uh-oh, the Fed is in it to win it, and they want to bring inflation down, and that is going to hurt the economy, and that's going to hurt the stock market. So you would see more people sell. But if traders and investors feel that the Federal Reserve Bank is starting to pivot, meaning they're no longer going to be aggressive with interest rate hikes, and they might even stop interest rate hikes in the near future, then that could create a stock market boom, because now the traders and investors are saying, oh, no more higher interest rates. That means no more pain to the economy. That means an upward rally for the stock market. Now, of course, the stock market doesn't operate in a vacuum. There's a lot of things that can make the stock market become very illogical, especially in the short term. And the things that can also affect the stock market could be the war overseas. It could be the energy crisis, along with a number of other different things. But everybody in Wall Street right now has their eyes on the Federal Reserve Bank, because on December 13th, the Fed is going to start their two-day meeting. And then on December 14th, they're going to make their next interest rate announcement. I'm not saying this for you to be a trader or try to trade the market. I am not a trader. I don't know how to trade. I'm an investor. But what I want you to understand is how the Fed can impact the economy and how that could impact the stock market, because sometimes the economy and the stock market don't move in the same direction. Sometimes the stock market can be very illogical, but if you understand the economy over the long term, that will impact the direction that the stock market goes. When the Federal Reserve Bank makes their decision on what to do with interest rates, the two factors that they're going to be looking at are inflation and jobs. Let me start by talking about inflation. Our November inflation report said that CPI, which is the headline inflation number, fell to 7.7%. Now, 7.7% is still extremely high inflation, but it's off of its highs of 9.1% or so. So it's starting to come down. And when the CPI number came out, it was lower than what was expected, meaning inflation was better than expected. However, the Fed doesn't like to look at the CPI number. They like to look at something called core inflation. Core inflation is when you take the general inflation number and then you remove what the Fed calls volatile numbers. And these volatile numbers, according to the Federal Reserve Bank, are food and energy. So when the Fed strips away these volatile numbers from the CPI number, you're left with a core inflation number. And still, in November, the core inflation numbers that the Federal Reserve Bank is looking at right now says that inflation was better than expected, meaning inflation was falling. But now in December, the Federal Reserve Bank is going to do something a little bit different. They announced this in their November meeting, that this time, for the first time in December, they're going to be looking at something called the cumulative effect of their interest rate hikes. Let me read you a little excerpt from their November minutes. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. What that means is prior to December 2022, when the Federal Reserve Bank would make a decision to raise interest rates, what they would look at is inflation, particularly core inflation, and compare that to the economy and jobs. If inflation is high and people still have jobs, it's more fuel for the Federal Reserve Bank to raise interest rates, because raising interest rates is a way to fight inflation. But now in November, what the Federal Reserve Bank said is they're going to be looking at this cumulative effect of their interest rate hikes. And what they're going to see is they're going to say, we raised interest rates so much in 2022, and while we haven't seen inflation come down to the levels we want, we can try to predict where inflation is going to be, and we can try to predict where jobs are going to be. So the Fed now could say potentially that because we've raised interest rates so much, we expect inflation to come down and we expect job numbers to also go down. Well, if inflation goes down, that's less likely for them to keep raising interest rates as aggressively. And if the jobs numbers go down, meaning unemployment numbers go up, there's also less fuel for the Federal Reserve Bank to continue raising interest rates aggressively. So it's pretty easy to understand what they're going to do when it comes to the cumulative effect on the inflation side. They're going to say that inflation is on the way down. But what are they going to say on the job side? Are they going to say the economy is going to improve or not improve? That's where there's a little bit more uncertainty. But you can kind of assume that when they say this cumulative effect, they want to continue interest rate hikes, but they don't want to continue doing it as aggressively. This cumulative effect is going to be a key term that you want to listen for on December 14th because, well, up until now, the Federal Reserve Bank has said that they're not going to slow down interest rate hikes until they hit that 2% inflation goal. Well, we're still very far away from 2%. 7.7% inflation is extremely high inflation. So we're still very far away from 2%. We're actually closer to the highs of inflation than we are to our target goal of inflation. However, this could be the fuel, or this could be the reasoning for why the Federal Reserve Bank can slow down their interest rate hikes. So this is definitely something that you want to be paying attention to because this is going to be a brand new thing that they're going to be introducing in terms of what they're going to do with interest rate hikes. So we don't know if they're going to start implementing this in December or maybe in 2023, but this is the term. This is the term you want to be paying attention to, and I'll be keeping you updated here on the Minority Mindset YouTube channel. And we also cover this, what's going on with inflation, the economy, the stock market, real estate, and the global economy in my free newsletter, Market Briefs. Market Briefs is an easy way for you to stay up to date on what's happening in the financial markets. So if you're an investor and you want to stay up to date, even if you don't have a financial degree or a financial background, not only are you going to understand what's happening in the markets, but you're actually going to look forward to reading Market Briefs every morning. So if you haven't read Market Briefs yet, I'll put the link to how you can join Market Briefs for free down in the description below. Then if we look at the recent jobs reports, the jobs reports also have good news. The jobs reports say that people have jobs, and the jobs reports say that people have the ability to get a job because there are more job openings out there than unemployed people. Now, you might not feel this way because many people in the economy today don't feel like the job market is very strong because people are struggling to find a job that fits their requirements, their needs, and their salary requirements. However, according to the data that the Federal Reserve Bank is looking at, because they look at the unemployment numbers, they look at the jobs numbers, and these numbers indicate that the job market is very strong and that there are about 1.9 job openings for every unemployed person out there. So according to this data, it says that every unemployed person has more than one option of which job and career that they can take on. So according to the Federal Reserve Bank, this is currently good news, and this gives them more fuel to continue raising interest rates. So if we were to look at this in the bubble, inflation is still very high. Inflation is still super high, actually. And jobs are still very strong. This, both tied together, would mean that the Federal Reserve Bank has the fuel to continue raising interest rates aggressively. Yes, inflation has fallen, and it is better than expected. However, it is still extremely high. But the thing that's different this time is this, the cumulative effect, where now the Fed could say, okay, inflation is high, jobs numbers are strong, we should continue raising interest rates, but we believe that inflation is on its way down, and we might believe that jobs numbers are on their way down, and because of that, we're no longer going to continue raising interest rates. This is the analysis that everyone's trying to guess, and this is where you don't want to be trying to predict what the Federal Reserve Bank does, but rather now understand what they look at, that way you can understand the economy, that way now you can be a better investor. And the reason why this is so important is because investors are the people that make the most money over the long term. It's not the traders, it is the investors. Sure, traders can make more money when things are booming in the short term, but over the long term it has been proven time and time and time again that investors are the people that make the most money. So what does this mean for you? Well, sometimes, like I've been hinting at, sometimes the stock market can be kind of illogical, especially in the short term. Sometimes the stock market goes up when the economy is going down. Sometimes the stock market goes down when the economy is going up. But what you have to remember is that the stock market is a long-term investment tool. And if you're investing your money for the long term, it doesn't matter what's going on in the day-to-day swings. What you want to be paying attention to is the economy. That is a combination of all these factors. And if the economy continues to suffer, because the reality is this cumulative effect is a real thing when it comes to interest rates, because we haven't seen the impact of high interest rates yet. The Federal Reserve Bank has raised interest rates multiple times in 2022. Well, our economy hasn't absorbed the impact of these higher interest rates yet. And that's going to cause pain to the economy because when you have higher interest rates, well, your borrowing costs go up, but also the cost of servicing your debt also goes up. Yeah, if you have a 30-year fixed rate mortgage, it's not going to affect you, but for most businesses, for most non-mortgage debt, these aren't fixed rate debts. And so now when your interest rate readjusts, you're going to have to pay more money to service the debts that you have, which means higher expenses. And on top of that, we have more debt than ever outstanding. Businesses, people, and governments have more debt than ever before. So we have a larger debt balance, and now the cost to service this debt is going to continually keep rise. And on top of that, revenues are falling. We are seeing the economy slow down. We are seeing impacts to the job market. We are seeing businesses see the profits get shrunk. Not all of them, but more and more businesses are doing that. Of course, you're seeing it especially in the tech sector, although a lot of people are saying that the tech layoffs are isolated as not going to impact other industries. However, you gotta pay attention to what the trend is and where the economy is going. If interest rates continue to rise, because even if the Fed does a less than expected interest rate hike, it's still an interest rate hike. And that's going to have impacts on borrowing costs. It's still going to make borrowing more expensive. Even if the Fed raises interest rates by 0.5%, that's still a pretty big interest rate hike. And that's still going to impact the cost of borrowing money 6 months from now and a year from now. So this is where you want to pay attention to the actual things happening rather than just the headlines, rather than just the buzzy things that create that short-term excitement or that short-term pain. Because if you want to make money over the long term, you don't want to be a trader, you want to be an investor. And that means you got to take out the emotion. That means you got to move away from the short-term rallies and short-term crashes and understand that investors make the most money over the long term. And the way that you invest now is you find good investments, or you use ETFs, use index funds, use other funds. If you're investing in the stock market, of course, you can invest in other assets. But if you're investing in the stock market, either you're doing the research to find good companies, or you're investing in the funds. And now either you can do a passive method where you're dollar cost averaging every week or every 2 weeks or every month into these assets and you don't worry about it, or when you see a good buying opportunity, meaning when the prices of things crash, that's when you come in and buy even more. And so when you see an economic slowdown, which we see happen every 10 to 12 years, then people lose their jobs. And when people lose their jobs, they run into financial problems because they don't have any money. And when they don't have any money, they don't have the ability to spend. When people don't have the ability to spend, well, then the economy continues to slow even further. Now, the 2020 pandemic was a little